Welcome to The Explainer. Today, we're not just looking at the news, we are getting under the hood and deconstructing a top-tier institutional strategy report to really understand the deep currents moving this market.
All right, let's jump right into the big puzzle. You look at the stock market, and it's just blasting through all-time highs. It seems totally unstoppable. And yet, if you look behind the curtain, you've got an energy crisis, you've got serious geopolitical tensions, and this hidden drain on the financial system's cash, all flashing bright red alerts. So how on earth can both of these things be true at the exact same time?
And this, right here, is how the report boils it all down in one sentence. They're calling it irrational resilience. Basically, the idea is that the story, the narrative around artificial intelligence is so powerful, it's acting like a painkiller, just numbing the market to the very real damage happening in the global economy.
So to really see what they mean, let's start by checking the economy's vital signs. Because, right now, the data is sending some really confusing and, frankly, contradictory messages.
Here is the fundamental conflict in a nutshell. On one hand, you have consumer spending, right? The engine of the whole U.S. economy, and it looks incredibly strong. That's the clear signal. But on the other hand, inflation, which was supposed to be going away, is getting sticky and starting to tick back up. And that's the noise that's creating all this uncertainty.
And what's so interesting here is how these numbers are just pulling in completely opposite directions. You see that strong retail sales number, and that tells a story of a healthy, confident consumer, which totally fuels a stock market rally. But then you see rising inflation expectations from corporations and gas prices creeping up, and that's a huge warning sign that future costs are going up, which should be a major problem.
So why isn't the market totally freaking out about this inflation problem? Well, according to this report, it's because the market thinks the Fed is just going to change the rules. It's focusing on chatter from a key Fed nominee who hinted that instead of fighting inflation, maybe they'll just start measuring it differently. Basically, moving the goalposts so they can justify cutting interest rates anyway.
Okay, so that brings us to the report's second point, and this is where we have to go a little deeper. We're moving past the headlines and into what you might call the market's hidden plumbing. This is where these analysts have found a really serious problem that most people are just not paying attention to.
So, to get a handle on this hidden risk, we first have to understand a little bit of jargon, the reverse repo facility, or the RRP. The easiest way to think about it is like a cash cushion. It's a safety buffer that the whole financial system can lean on when things get stressful.
And this number just perfectly illustrates the problem. That buffer, which used to have over $2 trillion in it, is now basically empty. That all-important safety net, it's gone. And that leaves the entire system way more vulnerable to a sudden shock.
But wait, it actually gets worse. At the exact same time that cash buffer was draining away, the U.S. Treasury's main checking account was swelling up. It has effectively acted like a giant vacuum, sucking over $1 trillion of cash out of the private market. This has created a hidden but very severe liquidity shortage.
So this is the crucial takeaway here. We are basically living in a tale of two markets. On the surface, what everyone sees is this incredibly exciting AI-powered stock rally. But just below the surface, there's a dangerously fragile foundation where all the cash needed to keep the system stable is just quietly vanishing.
Okay, so knowing that the foundation is that fragile, let's now take an X-ray of the stock market rally itself. Is it really as healthy and as broad as it looks on TV? Well, the report says absolutely not.
This chart right here reveals a huge red flag that pros call breadth divergence. So while the main S&P 500 index, which is dominated by the biggest companies, is going up, this other version, an equal weight version of the same index, is totally flat or even down. What that tells you is that this rally isn't broad at all. It's like a few generals are charging up the hill, but most of the soldiers are getting left behind.
And this donut chart just shows you how extreme this situation really is. A tiny handful of these AI-related mega-cap tech stocks now make up a staggering 45% of the entire S&P 500. This is a massive concentration risk. It means the fate of the entire market is basically resting on the shoulders of just a few companies.
And this crazy concentration has been supercharged by a technical thing happening in the options market called a gamma squeeze. It's basically a feedback loop where rising prices force computer systems to buy even more shares, which pushes prices even higher. It becomes a totally mechanical, almost parabolic surge that has very little to do with how much the companies are actually worth.
And this mechanical rally is now running red hot. I mean, key technical indicators like the Relative Strength Index or RSI, they've hit levels over 95. That is a severe overbought signal. It's like a car engine running in the red for too long. According to the report, it suggests this whole mechanical squeeze is running out of gas and could be near exhaustion.
So let's recap. You've got this incredibly powerful AI story on one side, and then this fragile liquidity star foundation on the other. With all this conflicting data, how does a real strategist make a decision? Well, let's look at the actual action plan laid out in the report.
Look, the report doesn't try to predict the future with a crystal ball. Instead, it does what the pros do. It boils everything down to two clear, data-driven scenarios. If certain bullish triggers happen, like things calm down geopolitically and the S&P 500 holds a key technical level, that points you down one path. But if bearish triggers hit, like oil spikes, so the market breaks down, well, that signals a totally different path with a completely different playbook.
But then, the report highlights a third, much more dangerous possibility that it seems like the market is totally ignoring: a black swan event. The risk is that the hidden liquidity drain we talked about earlier could cause the bond market, the very bedrock of the financial system, to suddenly seize up. And if that happens, the AI story won't matter one bit. It could trigger a full-on systemic collapse.
So what is the bottom line here? Given this massive tug-of-war between a bullish story and a bearish reality, the report's final verdict is a tactical neutral. The recommendation isn't to be a bull or a bear. It's to focus on defense. Protect your portfolio rather than chasing the last little bit of a very risky rally.
And the report leaves us with this final, really provocative thought to chew on. It suggests that when you see the biggest players on Wall Street loudly upgrading their price targets, maybe it isn't a sign of confidence. Maybe they're just trying to create enough excitement to find buyers so they can sell. That's a crucial question to ask yourself in a market this conflicted.